Gold prices coming off a little bit here late Wednesday following the news that the U.S. debt limit will likely be extended. Peter Hugg, Global Trading Director for Kitco Metals, joins me now. Pete, good to see you again.
It's good to be back.
So gold prices dipping a little bit here after reports that President Trump said he will support a 3-month extension for the U.S. debt limit. December COMEX gold last down here about $6, trading around $1338.50. Pete, how do you see it?
Well, the gold market, I made a comment when I got back from holiday the other day, indicating that the issue in North Korea, albeit creates somewhat of a floor for gold, has not been the main catalyst for this move up through 1300. The primary motivation for this move up through 1300 and its sustained rally has been, the perception that the Fed is becoming more and more neutral, if not dovish, on its interest rate policy. And the second most important thing is the inability of the Trump administration to get anything done. So, there were a number of issues that are coming up or were coming up in September and still are ahead of us because Trump does have the penchant for changing his mind. One was the Fed meeting, which I think will be a non-event. I don't believe the Fed will move in September, and right now I'm doubtful whether they'll move in December, since most of the Fed members have indicated that their primary goal is inflation, and the inflation picture is still very muted. The second event that was coming up in September was the debt ceiling, and looks like they've kicked the can again. It's not done yet, but it looks like they've kicked the can until December, which I pretty much expected, given the damage from the hurricanes and the new hurricane that may hit Florida, Irma, that may hit Florida over the next 3 days. So, the government knows it's going to need money, so increasing the debt ceiling just made total sense. I mean, the fight will still be in December on whether the increase in the debt ceiling will be a more permanent fixture or whether we have to go through this all the time. That said, excuse me for being verbose, but that said, the market's been pricing in some risks, and the debt ceiling being extended takes one of those risks off the table. Therefore, you see a little snapback rally in the equities and some profit taking in the precious metals. Right. There was a commentary this morning on the metals that I found very interesting, and I agree with. A lot of this move in the precious metals market is not because of investor participation in this market. By investor, I mean physical buyers. This has all been on the futures and on the ETF side, which has pushed the price of gold higher. We are yet to see reemergence of the physical buyer in North America. It's picked up somewhat, but it certainly is not very robust. And I think we're going to need that physical buyer to come in.
Peter, I want to pause you there because you say physical demand, but we are seeing demand on the ETF side of things, however.
Correct. We are seeing demand on the ETF side. I don't consider that physical. That's an exchange-traded fund. I know it's backed by physical, but I'm talking about the investor that buys physical product, whether it's coins or bars, and takes delivery or has them held in allocated storage. That was a big primary mover of this market between 2011 and 2014. And that physical buyer is only reemerging once you see silver below 16 or you see gold approaching or below 1200. At these levels, the physical buyers are not re-engaging. They don't believe in this rally enough to re-engage in physical buying. And I think that's a major component that's missing on the demand side in this market.
Okay, so you're placing a lot of weight on the physical buyers, because if we look back at that scenario, Peter, when gold had rallied to 1900 an ounce, investment demand was really the driving force back then, correct?
Correct.
So is that?
But there were two elements of the investment demand. You always have the trader that's in the futures market, and you have the sort of conservative investor that is comfortable with the risk of holding assets at financial institutions or on the exchange, and they are buying ETFs. Then you have a third set of investors that are buying precious metals, and they want physical delivery. And that group has been selling into strength. They have not been buying into strength, which is unusual. Normally, retail will jump in on a move higher, and what we're seeing is retail is selling into the strength. Now, that'll change very quickly once retail begins to believe that this move is for real.
Okay.
But that may not be until gold breaches $1,400 and silver breaches $20.
Okay, so all that said, and to wrap here, are you still constructive, the gold market here? You mentioned the changes that we're seeing at the Fed. Most members waiting for annual inflation to hit 2%. We see the news today, Fed Chairman Stanley Fischer about to resign in October. How can this play out for the gold scenario?
Well, Fisher was somewhat of a hawk, so it'll really depend on who the next voting member is of the Fed. It could be as hawkish or less hawkish, and then we can make our decisions. I don't think the Fed moves. I think they keep easy monetary policy, and I think what that will translate into will be continued weakness. Now, there will be rallies in the dollar, but I think the path least resistance is for a weaker U.S. dollar, which will be and continue to be price supportive for the metals. So I continue to look on buying dips on the precious metals price until the Fed gets its game on, and I don't think the Fed gets its game on until they see some serious action on the fiscal side from the administration, which is right now not evident.
Well, there's a dip today for you, Peter. Thanks so much for joining us.
You're welcome.
And thanks for watching this edition of Kitco's Gold Report. We'll be back tomorrow.